I'm not talking about this often on this channel, but I've actually studied finance. I've got a master in financial analysis, and the common narrative within academia is that markets are efficient, that all of the data that's currently publicly available is already priced in, and that whatever short-term fluctuations we see are random, right? It's new information that comes into the market, but I don't think that's true. Of course, nobody has a crystal ball. Nobody knows where prices are going, but we can work with probabilities, and there are anchor points in the market. And especially for crypto, the psychological anchor points are incredibly important. Because think about this. How do you make the decision whether or not to buy or sell a cryptocurrency? If you're long-term bullish, say on Bitcoin, for example, you do think that Bitcoin long-term will go up because the token inflation is very, very low and because fiat gets printed all the time. You think that over time Bitcoin goes up. What do you do if you're temporarily in losses in your portfolio? So you bought high and then Bitcoin went down for a bit. Very likely, you're simply going to wait it out. So you're not going to sell when you're in losses, when you think that long-term things go up anyways. And so your personal purchase price matters relative to the current price. If you're currently in gains, you might consider realizing some of those gains and maybe move the assets into another asset class. Say you buy some property, you buy some stocks, or you might just consume. Or when you're currently in losses, you might just leave it there and wait until things recover. Now what we're seeing over here is the realized price. So that's the average cost basis of the entire market. So it's not your personal reference price, it's the reference price of everybody. So we look at all Bitcoin. At what price did Bitcoin on average move? Then we just average this all out and we get this realized price. When the current price is above the realized price, the market as a whole is in profit. When the current price is below the realized price, the market as a whole is in losses. Thus, when the market is in losses, when the current price is below this orange line, we tend to see an ending of a bear market. The selling pressure tends to subside once we are that depressed. Now, why am I talking about this again? The reason why we are revisiting the realized price again is because it's one kind of equilibrium. It's the long-term equilibrium. But we can also have a look at market price equilibria in the very short term. So what are the short-term holders doing? Are the short-term holders currently in losses or profit? What kind of impact does that have on the price in the short term? What we are looking at over here is the short-term holder realized price. So that's the blue line. When the short-term holders are currently in losses, they might double down. They might buy the dip in order to then sell when they're high again, right? So the short-term holders try to just navigate the quick ups and downs, the short-term volatility. Now, how is this even possible? How can the market as a whole be in profit or in losses? Isn't crypto just another system where money flows from one person to the next, where it's just player versus player, etc.? How can the market at a particular point in time be in net profit or net losses? Think about this way. Say we introduce a simplified version of Bitcoin. Let's say Bitcoin had only 10 coins, 10 tokens, and they're all mined by a single person, Satoshi Nakamoto, that now has those 10 coins. Now let's say Bitcoin gets very popular. The first person wants to buy Bitcoin from Satoshi Nakamoto. He buys it for $1. The second person hears about this. They also want to buy it. Now Nakamoto has less Bitcoin left. He only has 9. So he sells it for $2 to the next person. The next person comes, the next person comes, etc. In the end, 10 people buy all the tokens from Satoshi. The 10th token is worth $10. So the current price at the market is those $10. But all of those other investors that came before, they are now in profit. So let's say the very first person that bought Bitcoin for $1 now decides to sell with this 10x return. They want to sell. They heard about that recently the last transaction was for $10. Since they want to sell, since they want to sell to somebody else, they have to be okay to take potentially less, right? That's called slippage. So there's normally a bid-ask spread in order books that goes now beyond this example. But in general, if you want to sell, you sell for a lower price than when you're buying. You're moving the market with your transaction. So the person that sells now from the $1 might have to sell it for $9, not for 10. That was the recent purchase transaction. Now they're selling for $9. The next person that bought for $2 now sells for $8, etc. Right? There's now selling happening. As more and more people sell, the price of Bitcoin is going down. And if it happens for long enough, then the person that bought for $10 before is in a lot of net unrealized losses. So this is always how it goes around, right? The way we determine what's the current realized price, what's the current market cost base, is by looking at all of the Bitcoin that have ever moved and for what price did it move. And we compare that then to the recent transaction. And so this is another chart, very similar to the realized price, but this time we look at realized market cap. So we multiply basically the price of Bitcoin times the number of circulating Bitcoin. And so we can see how much of the profit is currently unrealized. Or if the market participants that bought Bitcoin early were to sell now, what could potentially be the realization of their profit? What's also interesting is how the realized market cap or the realized price tends to almost go monotonically up, because again, the selling pressure slows down massively once the price is below the realized price. And so with this example, there are a few market participants that are in gains and others that are in losses. So let's say we are now selling from the $8 to the $7. The person that still bought, say for $3 or $4, they are in profit, but the person that bought for $10, they are in losses. So there's always people in losses and in profit, and we can then look at the aggregate. And so how much unrealized profit is there in the market? That's the green area. How much unrealized loss is there in the market? That's the red area. So we can clearly see that most of the time, the vast majority of Bitcoin holders are in profit. Even during a bear market, we just barely get into a balanced state. Most of the time, most people are in profit. And at the end of the bear market, things are somewhat neutral. And that's probably one of the reasons why Bitcoin grows over time. People just see how the unrealized gains are expanding over time. And so whenever Bitcoin goes down, it tends to be seen as another buying opportunity. Now we can play a little bit with the numbers here. So we can have a look at the unrealized profit and loss, and we can put this into relationship to the volatility of Bitcoin. So how much does Bitcoin go up and down? Is it rather calm, so it's not moving too much, or is there hectic times where the price is going up and down a lot? If there are hectic times, it's okay if we are temporarily a lot in gains. It doesn't have to mean much. But if the times are not that hectic, if the price volatility is rather calm, and then we are a lot in profit, maybe it makes sense to sell at that point. So we're not just looking at the unrealized profit and loss, we put this in relation to the volatility, to how risky the market currently is. And if we're doing this, we get the MVRV score, the market value to realized value score. And it tends to peak out at similar levels. And here is the good news of this video. The Bitcoin price is close to all-time highs, but the MVRV score is not. So the unrealized profit relative to the volatility is not at extreme peak. In other words, there might be more way to go up. Nobody has a crystal ball, of course, and nobody can say for certain that we are going to peak again at these similar levels, at 72K and at 100K. But it's definitely noteworthy that the market right now is not as heated compared to those prior peaks. Right now, people are not realizing their profit, and people aren't a lot in unrealized profit anyways. When the net realized profit is spiking, when the long-term holders are getting out, it might make sense to also consider taking some chips off the table. Right now, we are not there. The Onchain metrics look very, very bullish. There is one historical resistance that we have to overcome. But overall, the holder base is becoming more and more solid. We want to have money, we want to have Bitcoin as much as possible in the long-term holders' hands, in the diamond hands. We don't want to have this in the short-term holders' speculative hands, because short-term holders can sell quickly. Diamond hands, once they bought, they tend to just hold. And so have a look at how much of the supply of Bitcoin is held by long-term holders. When this is high, the Bitcoin price can rally afterwards. When this is low, a lot of the supply is held by the short-term holders, and the rally can slow down. Currently, the long-term holders accumulate again. They've got more Bitcoin than ever. And this again is a good sign, right? It means that the liquid supply of Bitcoin is rather low, because liquid means the tokens get bought and sold regularly. And that's the exact opposite of what the long-term holders do. So this is a very, very good sign. It's not the stablecoins that's currently driving the rally. That's rather balanced right now. Instead, and that might not be a surprise when you're following this channel, it's Wall Street that is buying, right? It's the ETFs and it's the Bitcoin treasury companies that push up crypto as a whole, but Bitcoin specifically. And what's so nice about this chart is how it's almost monotonically increasing. So those entities are just buying. They don't net sell. They have never net sold for a prolonged period of time in the last 5.5 years. It's unlikely going to happen anytime soon. This is a clear adoption trend by traditional finance. But yeah, all those numbers look great. The long-term holders hold Bitcoin and there's more and more long-term accumulation happening and the short-term holders aren't moving the price much. However, there's this one thing, this one resistance line that we have to cross. And I've talked about this also several times on this channel, but just because it's so important and it was so useful in the past several times already. This is again Bitcoin's price, very long term. It starts in 2010 and this is a curved line. There's nothing mathematical about this. It's just a drawing. But interestingly enough, this curved line connects the price cycle tops extremely well. For whatever reason, the Bitcoin rally always got rejected at that level. And we are very, very close to that resistance. That's the only strongly negative data point. It's simply visually the potential risk versus non-existent reward. But I do believe there is a very good chance that we're going to break this line once and for all. And then it's really price discovery mode. Then Bitcoin could go to 150, maybe 200K. That's actually my prediction. If you've watched other videos on this channel, 200K in Bitcoin in 12 months, I think is very realistic given the inflows. If we don't see any kind of massive interruption, if we don't see, say, an FTX kind of collapse or Terra Luna, anything like this, then at current growth rates, seeing 200K in 1 year is very, very realistic. So for example, this year, right, this is the stablecoin market cap, which continues to expand since October of 2023. It pretty much doubled since then. So a growth of 94%. And that's, of course, helping with this price rally as well. And again, this just continues up. There's no slowing down. And when we look at the stablecoin market cap relative to the entire crypto market cap, so how much percent of all of crypto is currently in stablecoins, we tend to be in a trading range in the last 1.5 years. And there is a direct inverse correlation with crypto prices here. So when the stablecoin dominance is low, crypto prices tend to be high. So this is Bitcoin here at the bottom. When the stablecoin dominance is very high, then Bitcoin tends to be rather low. So it goes opposite. And currently money is flowing into the space. The stablecoin dominance tends to rather go down. And there is still room for this to further fall, which would then bring Bitcoin up and then finally cross this pesky resistance line. I do believe that we will cross this at some point. Will it happen today? Will it happen in a week? I don't know. But seeing the long-term holders owning more and more of Bitcoin, while Wall Street continues buying non-stop, while more and more stablecoins flow into the system, I don't see why we shouldn't go above this resistance. We will likely go there latest by when we hit the 8 to 9% in the stablecoin dominance. If Bitcoin continues to go sideways and money continues to flow in, then the stablecoin dominance goes up. And once we are at 9%, at least in the last 1.5 years, we saw that money getting deployed. And that creates, of course, a nice sharp rally in the Bitcoin price. Now, within crypto, the decentralized finance sector looks quite interesting because across all blockchains, we are not yet at all-time highs in terms of total value locked, in terms of capital that's floating around. Asset prices in decentralized finance were way higher at the end of 2021. Then we had the Terra Luna collapse and the subsequent bear market, and now since October of 2023, the recovery. But we are still quite far away from the all-time high. Yet when we look at the number of stable coins that are now floating around, that is at an all-time high. In other words, there seems to be less inherent leverage in the system. So I do not expect a major protocol blowing up tomorrow. But it is important to watch both metrics, the TVL in DeFi, but also whether or not money is flowing into the space, right? This is what stablecoins are all about. So we are a little bit in no man's land here, right? It's a bit of a gray zone. We are not extremely cheap historically, but we aren't that heated either that everything is going to blow up tomorrow. The way how I navigate this is using the very badly performing altcoins. And I am not buying the altcoins. I'm doing the exact opposite. What we see here are the smaller altcoins with their performance in the last year. And just have a look at this, right? Bitcoin in the last year went up, but all of those altcoins, not all, but most of them went down. And so I'm betting on falling altcoin prices. I'm also hedging that versus the general macro. As in, if now Bitcoin and Solana and Ethereum was to suddenly go up, then my short positions in the altcoins wouldn't be affected by this because the relative performance of those bad altcoins to those major players matters. What we're seeing over here is my perpetual futures account with the current positions that I've opened together with the hedges. So it's expected that the hedges go in the opposite direction to the altcoin shorts. I've started the account with 40K 2 months ago. Now there's been more than 25% return already. I forgot to set a proper stop loss over here. That's why this went down more than I wanted to. Without that massive drop, the line would look much nicer and it would have been even more return. But 10%, more than 10% per month is more than enough for me. And so this is then how that works, right? We're just betting on poorly performing altcoins to continue to do bad. And this underperformance happens very constantly with very little volatility. And we can just flip this chart around, right? When we bet on falling prices, then it looks like this. Would you buy an asset like this? Would you buy something that continuously appreciates? Now this is a linear scale. On a logarithmic scale, it looks like this. Still, right? Very constant long-term growth under comparatively little volatility. So the chart isn't going up and down erratically that much. And I think this is really where the alpha, where the outperformance in crypto lies. It's not about finding the 1 or 2 altcoins that do a bit better. It's about exploiting the market structure. Now, why do we see so much red over here? Why do we see so many altcoins underperform that consistently? The answer is token unlocks. It's new tokens that hit the market and the demand not catching up to that growing supply. So this supply schedule here belongs to this asset. Every single week, there are hundreds of millions of dollars of unlocks in crypto. If money doesn't flow into the space at that rate, we see this kind of performance long term. Here are the tokens with most issuance in the next month. So for example here, right, WorldCoin is a token with a ton of additional supply hitting the market. And I shorted WorldCoin on May 23rd when we had a short squeeze and a very nice potential entry opportunity. So I shared that trade in the premium membership, that's thebitcoinstrategy.com. And then just a few days later, I closed the position. And yeah, if you've got proper risk management in place, you can make very nice returns. The community, of course, copy traded there as well. And so members got similar kinds of returns. But really, fundamentally, premium is not just about copy trading whatever I do. It's more about learning. It's more about exchanging information with the rest of the community and leveling up together. We want to take advantage of the market structure. We don't just want to blindly copy trade others. And so there are plenty of trades that I did not do, but that the community still benefited from. Crypto is a game of both luck, but also of skill. And the more we play the game, the less important the luck component becomes, and the more important the edge, the skill becomes. It's pretty much like in a casino, right? The casino does not know the outcome of a single game, but when the odds are in our favor, if we play often enough, we win. I mean, from the perspective of the casino, of course. And so I've published several tutorial videos on how to set this all up. How do we bet on relative evaluations, and how do we do this on Hyperliquid, which is the leading platform for perpetual futures in decentralized finance right now. And here, this video is probably even more important. How do we do proper risk management with that? Because while those trades look impressive, it's all about the long term. Most trades make money when we follow that strategy, but some don't. And we don't want to blow our entire portfolio just because of a single short squeeze. So yeah, feel free to check it out. It's currently $125 per month. If you've got a larger portfolio and you want to get feedback directly from me, you want to have a one-on-one session, you can also sign up for the yearly membership. For the yearly membership, you do get $250 off, so it's cheaper per month, but also there's a 1-hour Zoom call included. So I simply want to welcome everybody that makes a longer term commitment. And of course, we can talk also about other asset classes, not just crypto, how we are properly diversified across stocks, precious metals, property, etc. A link to premium should pop up directly over here. Just click on that link. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.